If you've been paying any attention to Berkshire Hathaway over the last few years, you're probably aware of their big bet on Japan. Buffett effectively sold debt to the Japanese at rock bottom rates, and then used the debt to pick up two of their best trading houses. Hedge fund managers call this an extremely shrewd move, showing just how sharp Buffett still is in his 80s. But did you know that this same opportunity is open to smaller investors? Today I'm talking to Oliver, who goes by Twaddle on X, formerly Twitter, who is exploiting this exact same glitch in the markets. If you love getting something for nothing, this interview is for you. But as always, remember that nothing in this video should be considered financial advice, and make sure to see our disclaimer at the end of the video. Oliver, how's it going?
It's going well, man. How you doing, Evan?
Not too bad, not too bad. We've been talking a lot on X, but why don't you tell everybody just a little bit about yourself?
So I'm Oliver. I'm probably known more often as Twaddle Inc. on my Twitter. I'm the one with the SW Kirby portfolio, and I'm a really big fan of net-nets, deep value investing, and very little bit of technical analysis. Currently, I'm working on, a Japanese net portfolio. That's what most people know me for. So far, I've been doing really well. I've timed it with the Japanese corporate reforms, where the Tokyo Stock Exchange kind of pushes the various stocks that are trading below book value. They want to ask the companies, hey, what are you going to do to return capital to shareholders so that you can reach a more reasonable valuation? So that's kind of what I've been doing this past few years.
So you're mixing up net-nets with crayons, I guess, marking up your computer screen.
Yeah, with the science of wiggles. That's what Peter Lynch often refers to it. But yes, just a little bit of wiggles, a little bit.
So, okay, good. And you submitted this picture to us. It's a big pink Kirby. I think people can see it on the screen. Is this what you actually look like, or what's the deal behind that?
Yes, so I love that you asked me this as you see me in person. That gives me a little chuckle. Not gonna lie, Evan. The SW Kirby picture, prior to its Super Saiyan form, its current iteration at the moment, it came from a meme saying when you go to the gym, when you can tell that you work out, but you also get a cookie every time grandma offers it. And I thought that perfectly encapsulates my personality. I like to work out. I like to go to the gym. But, if grandma, and, may she rest in peace, but wonderful woman, but anytime she gave me food, I would accept it graciously. No complaints, no calorie countings. I would eat grandma's food.
You're living my life. That's exactly what I do. I don't have a grandma anymore, but I do have a mother-in-law, and she likes to feed me tasty Korean snacks. So that's why I kind of have a round face, but big muscles.
There you go.
So what exactly are you doing in Japan? Because you're doing something interesting with investing, and you're the first person that I've ever heard doing this. Well, except for another guy that I think everybody knows that we'll talk about a little bit later in the video. But what exactly are you doing in Japan?
So with Japan, a portion of my net portfolio, and this is actually not my idea. This came from Alte Capital, another great user on Twitter. Highly recommend to follow. And he received it from that one investor that we all know. And essentially what I'm doing is I'm borrowing on margin. Now, this was much better a year ago. Using interactive brokers, you can borrow on margin yen for 0.75%. And
wow.
Yeah, it's very, very cheap. And this is due to, and I believe it's 0.85% now. You do need to have a certain amount. If I recall, around 800K. Unfortunately, I'm not that big, but if any bigger investors are watching, this is something you can take advantage. The rates for me, I believe, are 1.85% at the moment. So they usually, And prior to this, it was 1.5%. And what's interesting is Japan has these very, very low rates. And usually with low rates, you would expect equity premiums to be a lot higher because investors would be searching for anything that would give them a yield. Imagine if the U.S. was only giving us 0.1% 10-year treasury yield, which I could be wrong, but I believe Japan was at that point.
Mm-hmm.
We would run for anything. A 2% dividend stock would seem golden at that period. But what's interesting with Japan is at least from what I've seen, is there's a lot of these rich dividend-paying stocks, and many of these are net nets. And these net nets, some of them are trading below EV. A lot of them have positive net income. They have more net cash than their market cap. So these are like some of the safest investments I feel like you could make from a downturn perspective. So I kind of see it as a creditor, as a bank creditor, where I'm borrowing at 1.85%, and I take that money and I buy a Japanese net, and the company could be paying me 4%, 5%, 6%. And I'm looking at it as a creditor is, will this company go bankrupt? Yes or no? And when it has more cash than its portfolio, it's kind of great. So what happens is I make the difference off that spread as I wait for mean reversion, or in this case, maybe not. The term mean reversion might not be the most precise, but price expansion, multiple expansion to a more reasonable level. One way I like to look at these net nets is I like to look at the past price per NCAV, the history. Ticker allows me to do this, and via that I can see if it fluctuates. And oftentimes I like to buy these companies that fluctuate. They go from net to not a net to a net again. And I like those. I try to avoid the forever net nets. A lot of these companies, some of these companies, they had something happen in 2008, and they've stayed in this cheap range the whole time. So given the fact that with Japan, at the very least, with Japan, I'm pretty much solely quant, I like to avoid those type of situations.
And so you're talking about Ticker Terminal, right? So that's the platform that allows people to look up, it's like Google Finance, or Google Finance used to be. Now Yahoo Finance kind of provides that same service where you can look back over financials and charts and ratios over a long period of time.
Yeah, and you can also look at previous price multiples, which I'm a huge fan of. So you can look at what the previous price per book was for this company and how it's changed over time.
So obviously Japanese net nets are kind of famous for being slow growers, but they do, well, if they grow at all, but they have, a decent dividend in the 4 to 5% range, nothing to write home about, but kind of, something your grandma might have invested in. Are you kind of taking advantage of the spread between the interest rates and the dividends?
Oh yeah, of course. So it's kind of like I'm running a minor bank. I'm taking advantage of the spread, but I also tend to buy net nets that are growing, perhaps not like earnings, like percentage, but every year they're positive net income. So they're growing their book value. So one of my valuation metrics is I like to look at the 5-year KAGR book growth rate. I like to add that by the dividend. And my idea is, hey, if the stock does not re-rate, and if it stays at its price per book multiple, this is one of an estimate of what returns I could get. And I like to look at those, and I like it when it's above 8 or 9%, and that's one of my metrics.
So if the stock's trading at a 25% discount to net current asset value, and it keeps, that range, but the net current asset value grows at 10%, you would expect a 10% return over time, right?
Right. And also the nice part
and
about...
then add the dividend on top of that?
Yeah, including the dividend that's being paid each year. And another nice part about the dividend paying stocks that I like, in addition to the psychological advantage, is, if they're paying like a 6% dividend and they drop by 50%, and oftentimes I look at these companies and they've been paying a steady dividend for 20 years, 10 to 20 years. What's nice is, if the stock drops in half, I get a 12% yield. Sometimes. Now, sometimes it could be dependent on earnings, but some of these companies, they actually pay a dividend based off of equity. And those I find interesting. Mm-hmm. So if it's like, we'll pay you 3% of equity, that is something that you can expect to stay that way, even if earnings go through, a bad year or two.
Very interesting. Very interesting. So basically any money that is leaving your account due to the interest on the loans, you're just paying from the dividends and you get the stock basically for free. This episode is brought to you by Event Driven Daily. If you're spending too much time trying to uncover special situation stocks, make sure to look at Event Driven Daily's Morning Brew newsletter. Each month, we scour the internet to find as many special situation opportunities as possible, and then send each and every special situation to free subscribers in a neatly packaged email. This service is absolutely free and will save you hours each month trying to source special situation ideas. Go to www.eventdrivendaily.com and look for the subscribe button at the top of the page. That's www.eventdrivendaily.com. So what's your loan to value? Or, if you're borrowing, for the people watching this, that kind of means how much you're borrowing on the equity that you're buying. So if you're spending $50,000 to buy Japanese net, are you borrowing $40,000, $50,000, $60,000? What's the ratio there?
So I would say my ratio is around 30 to 50%, depending on a given time. Now, my entire port isn't Japanese, isn't just Japanese net. So overall, it's going to be like 10 to 15% margin compared to the overall equity. So it's not too big of a difference. And when it comes to that, I'm only going to be buying the nets that are paying a dividend above that 1.85% yield.
Yeah, that makes sense. So I guess most of the nets in your portfolio probably have a dividend in the range of 4 to 5, right?
Yeah, well, I have one exception that I recently posted, and it's actually at 0.85.
Ooh.
But I wouldn't recommend buying that one. That one is interesting because it has a lot of growth, both top line and bottom line.
Mm-hmm.
I can share it real quick. I'm just going over because I always forget the numbers. Like I can remember the name. It's never like a stock like Meta where we remember META. It's always like here's the name. It's a 9867 Soleica Limited.
Right, makes it really hard to remember.
Yeah, that one is really interesting because it's negative EV and it's selling at 59% of NCAV, and most of that NCAV, as in like 91%, I believe was the exact, is cash and accounts receivable. So I like this. I like it when it's not. When I look at nets, I like it when we're not basing it off of inventories. But this one is growing, and because of that growth, I am kind of... I decided to purchase it, as part of this basket of nets.
Are you comfortable saying the name?
Yeah, it's 9867 Soleica Limited. I recently did a post on it on X, but yes.
Okay. How long have they been growing for?
They've been... I'm just going to open up their financials real quick.
He's doing this live, folks.
I have a nice spreadsheet with some of my own custom metrics as well. So one of the things that I liked about them was I like to look at average 10-year return on equity, because with these nets, we're looking at companies that are mainly deriving their earnings from their existing assets.
Right.
So I like to think of myself as, hey, if you're buying a house and that house on original cost is returning 10%, right? And you buy it for that original cost, what's your return going to be? 10%. Now, let's say we buy that house for half of the book value, aka the original price it costs to buy that house. What is our returns now? I would say 20%. If you've been returning 10%, so I like to do it. That's one of my ways. I like to use ROE as a way to normalize earnings. For this company, let's look. So let's see. So their book value KGR has been 9.07% in the past 5 years. They're currently trading at 58% of NCAV. Dividends is very low, 0.8%. Their average ROE, it's reasonable, 6.16%. Perhaps not the best, but given that it's a net, I'm not too surprised.
Cost of capital also much lower in Japan too as well, right?
That as well, yes. And given the fact that I lost track, we're going to have to cut that out.
Sure, not a problem.
9.8. This is a lot harder than I thought it would be.
Oh, what, the podcast?
Yeah.
Okay. Well, I mean, you don't...
So they've been growing, if you look at... They've been growing their revenue. It's kind of going up and down, but it's consistently been growing. From 2016, their revenue was 20 billion yen to Yeah, billion. 20 billion yen and right now it is 28 billion. So it has been growing, and every single year has been positive operating income. Operating income in 2017 was 259. Now it's 1,727. So there is decent growth, and there's a little bit of a cycle.
Right.
Like in 2021, they were 1.2 bill, and then they went back to 715 bill, and then they went to 998 bill, and then they went to a whopping 1.6 bill, and back to 1.7. But the general trend is that they're growing, and considering that it's an end cap selling, I mean, we're not even just saying selling below net current asset value. This is a negative EV, so we're saying below net cash. Right. I would say this is pretty great. The only issue is how will they return to shareholders? And that is where I would say the risk is. I say if you put it in a basket, I think you'd be fine. If you put your whole life savings into it, you could have some issues. But
you might have some issues, yeah, if you do that.
You might have some issues, right? Especially if you put it in margin, because it won't be paying back your margin interest either.
Right.
But I do like that idea of growth, especially when the smaller the market cap, because growth can oftentimes be a trigger for
revaluation.
The market for valuation, right? Because as a company grows, it gets bigger. More institutional investors can start looking at it. More people can invest in it. The more institutional investors join in. This is something I learned from Ryan Telford, who is another user on X, is that the change in institutional investors is a metric you can use to actually give you superior returns, back test it at least. So we oftentimes think that, hey, we want more insider ownership, and there's nothing wrong with that. But when we shift more towards institutional ownership, that's often a sign of a company becoming more aware publicly, and that means the sentiment changes, and more people are discovering it. And as more and more people discover it, as its market cap rises, more and more institutions can invest in it. It becomes a reasonable investment, and that can, momentum. They always say never fight against momentum. So
yeah, exactly. And then if you're looking at growing nets, that's definitely one factor that I like to look at. There's a book called Choose Stocks Wisely by Dr. Paul Allen, and he's basically a low price to net tangible asset investor. But one thing that he always looked for was growth, and he apparently did quite well using that approach. So when you're looking at the Japanese stocks, that's definitely something to look for. But there's a caveat, with Japan and a lot of these companies in Japan, these nets. First of all, if you can find the financials and, translate them into English, that's great. But I'm always a little bit wary about how do you know that growth is going to continue in the future? A lot of these are, commodity businesses, and there's no obvious way to tell whether the business is going to see continued growth or not. So that's maybe a little bit risky, because if growth falls apart, then the stock can crater as well.
Right. So I agree with you on that a lot. And the way I see it is I never invest in a company solely because of growth. The company in the moment has to be a value play. So with the example of Soleica, even without growth, it's selling below net cash. And with other companies, oftentimes I'm getting paid a dividend. So the way I would say it with those is it's already cheap where it is, even if growth slows. And I would argue that growth will not. Growth can slow down, but the investment, even at these prices, even with zero growth, is cheap enough. And I would say I'm willing to take a risk within a basket position, even if that growth slows down.
Right. So where are you borrowing from? Is this right from your broker?
Yes, it's from Interactive Brokers.
Okay.
If I recall, I believe Interactive Brokers and Fidelity are the only two brokerages for retail investors in the U.S. that allow us to trade internationally. I think the SEC makes things very difficult here in the U.S. The reason why I know this was I had some adventures in Russia a couple years ago when the war started.
Yeah.
And I was able to purchase Russian shares via Interactive Brokers.
Interesting.
But they actually started banning it. They only allowed you to sell and exit out of positions. So I was trying to find an alternative, and unfortunately, it seems like Fidelity and Interactive Brokers are the only two for the American audience listening if they're interested in these international opportunities.
It's the nanny state keeping you safe. I mean, what more could you want, right? Just want to hold you tight and take your money.
Yeah, and the nanny state has recently banned dark stocks as well. So
Right.
that has I've never invested in a dark stock, but the nanny state stopped me before I could even try. But I started following these people, and I'm like, wow, this is such an amazing opportunity. But opportunity went by, so.
Right. Yeah. It's frustrating to no end, but I mean, maybe that's something for another podcast. Now, Interactive Brokers, you have to have a certain amount of equity in your portfolio. So I guess if you're borrowing 50% on your portfolio, is that kind of where you're at, 30 to 50% on the entire value of your portfolio?
I would say around 10 to 15%. 30 to 50% is on the Japanese portion of the portfolio, but the Japanese portion isn't my whole portfolio.
So what portion of your portfolio would you say that is?
I actually don't know. I think because I also have a Fidelity brokerage as well. So
okay. So it's a pretty small portion. I mean, would you estimate maybe 25% or something like that?
I would say I think it's 50% of the port. I would have to convert some other currencies to verify.
Okay, so you're looking at 10 to 15% on the entire portfolio. Okay, that's not too bad. This episode is brought to you by NetNet Hunter, the best resource for NetNet stock investing on the internet. NetNets, or cigar butts, are sub-liquidation value stocks that produced such outstanding returns during Ben Graham's lifetime that he gave up all other strategies to focus on them. Professionals such as Warren Buffett and Joel Greenblatt also launched their career on the strategy, and that proved quite successful to say the least. Right now, you can get a free monthly NetNet stock pick from NetNet Hunter's free newsletter. Visit www.netnethunter.com and look for the link on the homepage. Now, there is a famous investor who is kind of taking a similar approach to investing in Japan. His initials go by WB. What do you make of that? Because he borrowed, I guess he borrowed fixed rate debt from a Japanese bank and then bought those brokerage houses.
I believe, I could be wrong about this, I think he sold bonds actually directly to the Japanese public, and they purchased it from him.
Really?
And it was like, yeah, I think Berkshire explicitly sold bonds. I could be wrong.
Interesting.
It fascinates me because you can only do such a thing in Japan.
There's such a large company as well that they can probably, sell those bonds and it wouldn't be an issue.
Yeah,
and he's so famous, so he's obviously using his name and Berkshire's reputation to sell that debt.
Oh, of course, and to be honest, he deserves his reputation from.
Right.
He's an honest businessman, and for the most part, I think those bonds will be paid back. But what baffles me is the fact that the retail investors are willing to buy bonds at 0.56% interest rates when these cash rich, and even if we go away from the realm of NetNets, the ugly, dirty cigar butts, the Ben Graham plays, I'm sure there's some prestigious Japanese businesses out there that are paying a 4% dividend, a 5% dividend, a 6% dividend. I wonder, and I have my own opinions on this. I think a large part of it is because of the Japanese stock bubble and the crash in the 90s that I believe they only recently recovered a few months ago, and I don't even know if the stock market has gone down. But it took them 30 years for them to recover from that bubble. And I would imagine, especially in a culture like Japan, where the whole, the phrase, the nail that stands out is hammered in. I would expect that, after the trauma, I would say it's a trauma. I mean, like, imagine, like, for 30 years, you bought at the very top of the bubble. Only now would you reach where you were before. Like, even during the Great Depression, we didn't have such a thing like that. So I would imagine that.
What's interesting is there is a study that came out on value investing in Japan over the period of the market decline, and value actually obviously outperformed, but it also provided good positive returns over that period of time. So kind of something to think about as well.
Yeah.
But you would think that if they trust Buffett enough to buy bonds from him, why not look at what he's buying and just buy those companies as well?
I'm sure they do that actually. I'm not sure if they do the Japanese companies though, but I have noticed this. This is not Japanese, but I once dated an Asian girl, a Chinese girl, back at my college, and I went to UCSD, so we had a lot of international students, and I recall her aunt was really into investing, and this is like this is post COVID, so this is when the markets were going up and up and up and up, and stocks only go up, and her aunt was saying things like, oh, invest in American markets, it's so easy, and it just kind of like it made me think, because here we had a Chinese woman, and it wasn't even a Chinese American woman. She lived in China, I believe in Shanghai, and instead of investing in local companies that she would know more about, she would understand more about, she would just be buying these American companies because in her mind, American stocks only go up. And I wonder if that's what a lot of Japanese retailers do, if maybe they just buy into the S&P 500 or U.S. American stocks rather than their local companies, because, you know, when you look at some of the Japanese companies, they don't have much of a profit nor a decline, to be honest, that's the part that baffles me. It's like, even if you buy them, if you're getting that 5% dividend, you're beating whatever Warren Buffett has given you.
Right. Right. Yeah. I don't know. It's kind of funny. You know, American investors go to Japan, Japanese investors go to the US. Everybody's looking at, you know, the other side of the fence where the grass is supposedly greener.
Yeah.
I don't know. I'm just looking for value. Value with a catalyst.
Of course. Yeah. And speaking of value, another interesting market that I myself have not really looked into, but I really should, and I probably will start, is the Hong Kong market. It seems like there's a lot of interesting stuff there, but I've tended to avoid that marketplace and stick with Japan because I can trust Japanese accounting for the most part.
Yeah, if you can understand it. But one thing about China and investing in Hong Kong kind of feels like investing in Russia before the Ukraine invasion. You know, there's a lot of stuff going on between China and the US right now. It's no secret that China wants to take Taiwan, and apparently there's a big military buildup right now. So I don't know. I kind of see Hong Kong as being a unique risk from that point of view. So it's not just cheap. If you go back, you know, 10 years ago, 15 years ago, 20 years ago, or something like that, it was very much still a very British place, and you could trust the accounting a little bit more, and the relations with the US were a lot friendlier. Now I think the risks are skewed against the investor, even though there are some really dirt cheap companies there.
Yeah.
So I've been tempted as well.
I mean,
thinking about that risk.
At the end of the day, what matters is ultimately the price and what you're, and the price can be so cheap that the risk may be worth it. I don't know if it is. I haven't looked at HP. Obviously, like you said, there are legitimate things that are causing the prices to be so low. So many of these companies perhaps are not worth it. But I'm just thinking about Russia because, you know, I myself invested in it. But I'm also thinking of another gentleman we both know, Li Lu. I'm sure many of the audience has heard of him. But I'm thinking because both my parents are from the Soviet Union, so it's kind of interesting. I do have a little history here. But Li Lu was purchasing Russian companies during the fall of the Soviet Union, which I would imagine was a very, very risky play.
Right.
Because you don't know what the new government's going to come in. You don't know the new government's going to continue the communist policies. They could, within 5 years, nationalize all these new businesses.
Right.
Obviously, from hindsight, we can be like, wow, this was so easy. I don't think it was that easy. I think very few American investors even wanted to touch that area. What was interesting, though, is there was such a unique situation because Russian citizens, it's kind of similar to Japan, just because of like, this would only happen in this scenario. So with Russian citizens is they're from the former Soviet Union, so they never had a stock market. They never had a stock exchange. They never learned about these things. They never learned about things like price, supply and demand. It was just the government, the central government would determine what the prices are, and those prices remain that same. So food prices never went up. They never went down. Now they did have food shortages. They had food lines, bread lines, etc. But this new form of free market they didn't know about, and Russia was undergoing a lot of economic chaos, and every worker was assigned portions of shares based on what their position were. So if they were a manager, they would get more shares of a Russian business that is being privatized, so say Gazprom or whatever. So each worker would receive shares of the company. Now, most citizens didn't know what these were. They thought these were just pieces of paper, and they were more concerned about feeding their family than the piece of paper that was just given to them. So what's happening was there was massive selling at this period, and people like Lilu would buy, and the original Russian oligarchs. So original Russian oligarchs, most of them were middle-class citizens. They purchased these shares at these cheap values, and they became oligarchs. And in that scenario, going back to Hong Kong, I would say like it's kind of interesting because the price got so cheap where Lilu was buying oil companies for less than the oil reserves. So forget about the factory, forget about the machinery, forget about the land, forget about the potential future output. I'm talking about the oil reserves at that present day. He was buying cheaper than that. I think with any scenario, the price can be low enough to justify the price. The reward can justify the risk, if that makes sense.
I have to agree with you definitely there. If the price is low enough and the asset quality is, fairly robust, then at some price, it's definitely worth buying despite the risks. I know Lilu is giving that talk about, his investments in what was the oil company he invested in?
I believe it was Lukoil. Or
Yeah. Okay.
He bought it less than the barrels that they had at that time. So I think that's what he was saying. I think they were trading less than their current reservoir of oils. Like not even reservoir, like what they had at the moment.
So what
forget
they had
about land.
Up?
Yeah, what they had stocked. Forget about land, forget about machinery, forget about future reserves. It's kind of absurd, right?
It is, yeah, definitely.
And many of the risks did catch up, by the way. So this isn't like this is a non-hairy situation. I mean, Lilu left. He profited a lot, but he left because there was a lot of first of all, there's a lot of racism in Russia. He felt that they were going to try to cheat him out of his shares. After the price reached a point where it no longer justified the risk, and he went out. So I like that idea of just being flexible.
Right.
There is a point when it's too risky, but if it was cheaper, if it was maybe the risk to reward ratio is more favorable.
Yeah, at some point you do have to buy despite the risk. You just don't make it a big part of your portfolio.
Agreed, yeah.
Yeah, for sure. Okay, so we talked about what you're doing in Japan. We talked about interest rates, where you're borrowing from, loan to value ratio. Let's talk a little bit about risks here because, obviously stocks don't go to the moon unless you're a TikTok investor. So at some point, there's going to be a market hiccup. There's going to be a downturn. What do you do then?
So the safest way to invest in these nets, I would say, if you want to really minimize your risk, is not to do any of this margin plays. And that way, especially if these companies are rich in dividends, you have that psychological protection when these market downturns happen. So they go down, or maybe it's been 3 years, 4 years, and your stock hasn't gone up or down. To me, as an individual investor, and knowing my personality, whether it's optimal or not, I like having that dividend. I like knowing that, hey, I'm still getting paid to hold this. And every year they're sending me the checks. And another thing with dividends is they often offer a base. So if a stock is trading at a 5% dividend and the shares go down in half, you got a 10% dividend paying company. In my opinion, that is not going to last, even in Japan. Mm-hmm. Even when I'm looking at these nets, I have found some companies that are paying 13% dividend yield, but they usually have a lot of icky situations, as in a huge net income loss. Maybe they've been end caps for a while, huge asset write down. There's usually something there. There seems to be a limit. So I would say the biggest way to mitigate risk is not to engage in margin. When it comes to margin, I stick at a 10 to 15%. So I feel fairly confident that even if the market does go down, I will have, from my source of income, I'll be able to add in enough money to compensate if necessary.
Okay. So you won't be completely screwed. That's good.
Well, we're value investors, right, Evan? So our priority should be minimizing the downside.
Right.
And when you minimize the downside, often, there's only one direction to go.
Right.
I like that idea, that preservation of capital.
I do as well. Yeah. Hasn't always worked out, but yeah, that's definitely a good concept to internalize.
You broke Warren Buffett's first two rules, man.
Yeah. There's only two rules. Now, in terms of protecting your downside, I guess you could always hedge, right? Have you thought about buying puts on the market or on your companies?
No, I don't hedge any of my bets. I keep it very simple. My portfolio is small at the moment. I may consider it in the future. I just need to learn more about it. I've considered hedging currency as well, but I've kind of decided to just leave my yen within yen. So if I sell out of a net, I just buy another net with that money, or I buy a different Japanese company, and then that way, after 20 years, we can see what happens and go from there.
Right. And if you're borrowing in yen and your income is coming in yen from your dividends, then hedging your currency doesn't really make sense anymore.
Yeah, especially the margin plays. There's no reason to hedge at that point because it's not even US dollars. You're borrowing. It's not even your money. So
right.
Yeah.
Exactly. Anything that you want to kind of leave the viewers thinking about if they want to go down this route?
Sure. So I'd like to give a shout out to my friend Alte Capital. Me and him started doing this. I believe he's been doing this for longer. He's a lot more of an experienced investor than me, but he is huge in the Japanese net investing space, and he writes a lot on his Substack. So please give him a follow, especially if you're interested in going down this path. Feel free to follow me. I'm Twaddle_Inc. Twaddle is a word used, if you're interested, Evan, it's a word used by Charlie Munger. It's kind of like BS, like that's twaddle, like it's just he's talking twaddle. And
I thought it would be something to do with anime.
No, I do like Dragon Ball Z. Evan is aware of that. And for the second thing, I'd like to say, with regards to any form of deep value investing, I'd say keep searching, keep looking, use screeners, find your own way. When I first started, I was using a Python scraper tool. Ticker didn't offer anything for price per NCAP. They've recently added it. So I was finding ways to kind of scrape and do the calculations myself. Feel free to do it. Ticker now offers this, but I would say be wary of a lot of naysayers. When I first started value investing, everyone told me that these nets don't exist. They never will come back. This was something that Benjamin Graham and Walter Schloss did in their time, and now there's gone. And I think there's truth to that, especially in the U.S. markets. The puddle's been getting smaller, but I would say if it's getting smaller in the U.S., start looking internationally. And so far, I've been finding a lot of things. I'm sure you've been finding a lot of things with your Net Hunter page. I just want to say that these opportunities still exist, and even if they don't, at least take the time to search. I'm really happy that I took the time to search because for my first year of investing, I just avoided even looking at stuff like this because I thought they no longer existed, or there's a reason they're cheap, or this or that. And I no longer believe in that. And I think we should always be searching and finding the best opportunities we have at the moment.
It's really interesting when I hear the professionals say that nets don't exist anymore. I know Charlie Munger has given a lot of speeches and people ask him questions and then he says, those companies don't exist anymore. And if we ever found one, it would be too small. The truth is they just don't look because they are too small, right? They have too much capital put to work and these companies are too small, too illiquid. So can't jump on those.
Well, speaking of illiquidity, Warren Buffett actually, and he said this, I believe, not even many years ago, but he said they asked what he would do if he was small again, and he said he'd go through the A through Z's and he'd be going through the really, really small cap companies. And he said that he could make, the way he phrased it was, he said, like, I think I could make 50%. And then he said, wait, no, I don't think so. I know I could. And these were Buffett's earliest returns. Buffett was making, when Buffett was a small investor, when he was unencumbered by the size of Berkshire Hathaway, he was making his best portfolio returns. And, you know, hearing that from Buffett, it's kind of nice, because it's kind of like, hey, even if I do half as Buffett, because we're not Buffett, right?
Right.
But if we can do half as that, 25% is pretty good. If we do a third of that, it's still good. Like I kind of like that idea of fishing in ponds. If we are retail investors, we might as well take advantage of every edge we have. And I'd say there's an edge in being small.
Absolutely. Yeah, there definitely is. Thanks for being here. Thanks for telling us what you're doing in Japan. It's been an awesome conversation.
Thanks, Evan. Thanks for having me here.